These are some of the books that I've read about stock analysis, technical analysis, options trading, day trading, long-term trading, investing, you name it. You can see I've got my bookmarks for specific things, but you don't have to read them because I'm going to tell you the things that I've taken from them that have actually been helpful. Get rid of those. Today we're going to be talking about stocks, specifically options. Options might sound scary to a lot of you, mostly because a lot of people don't understand them. But if you don't have a lot of money or capital and you want to get some greenbacks, that is the quickest and easiest way to do it. Well, I wouldn't quite call it easy, but there's a lot of opportunities in the market to make a bunch of money pretty easily. So we're going to be looking at some scenarios where you can trade some options and get a strategy that will help you to make a bunch of money on the stock market, hopefully. If you don't understand some of the information, or I start blabbering and stuttering and going back and forth, just watch that part of the video again until it makes sense. And it might sound very boring to you guys. I get it. I really do. I know, because I've read all of this crap, all right? Especially sitting and listening to me talk for however long this video is. But I promise you this information is very, very important and very helpful, especially if you want to make money. At least I hope it is anyway. I mean, so just watch the video. If you only have $500 or $1,000, you can't buy 100 shares of Apple. So you might need to buy some options. If you buy options that are far enough out, or you scalp options, then you can make a lot of money a lot faster than buying stocks. This is not gambling. This is not scratch offs. This is not playing the lottery, lightning striking, you know, getting lucky on a right pick. No, this is based on real data, on actual analysis. By the way, I'm doing this for free. I'm not charging for any of this crap. I'm not asking you guys for anything. I'm just sharing what I have learned, hoping that it will help you guys. There might be somebody down there in the comments trying to sell something, or trying to pretend that they're me or whatever. That happens a lot. It's not, all right? I'm not trying to sell you guys anything. So with that being said, here we go. With options, you do have a couple of things that you need to consider, such as your Greeks, as they call them, delta, vega, theta. Basically, you got a bunch of freaking frat boys who came up with these delta, theta, vega, Greek crap so they can make themselves feel smart whenever they're talking about stock, like strike price and all that. It's all frat boy stuff, man. All of it. But if you can decode it and understand it, it's actually very, very simple. Because as we all know, frat boys are very simple. So basically, theta is your time decay. With options, they have a set time frame for you to be able to use them. When you purchase an option, you are purchasing the option to buy or sell a specific stock at a certain strike price, or at a certain price. One option for 100 shares, essentially, is what it is. And with that option, you also have a time frame that it has to be exercised by or sold. That is what your theta is based on, is how much time is left between the day you bought the option and when the option expires. Now, you also have your delta, which is the price fluctuation, how much the price actually goes up and down. And then your vega, which is your volatility. Basically, it's like implied volatility is how volatile is the stock usually? How volatile is the premiums? It tells you how much the stock moves volatility-wise. I mean, you can literally Google delta, theta, vega, and it'll explain it to you. If you don't understand that, listen to it again. I probably didn't do the best explaining it, but delta is the measure of change in an option's price premium resulting from a change in the underlying asset, while theta measures its price decay as time passes, closer to the expiration date. Vega measures the risk of changes in implied volatility, or the forward-looking expected volatility of the underlying asset price. So how volatile is the stock? That's what vega is. V for vega, volatility. T for theta, time. D for delta. Frat boys. You know what I mean? So there's two different big strategies, main strategies that you can use that basically encompass two types of options investing. One would be buying and selling calls, just flat out purchasing calls and selling calls, or buying puts and then selling those puts. Or writing covered calls and covered puts, which means if you already own the stock, you own 100 shares of that stock, you can actually write a call contract and sell it, and you get free money for that contract. If you want to hear about writing covered calls and puts, then you can skip ahead to that. Right now, I'm just going to be talking about just buying calls and puts and some of the implications, some of the things that you can do. This is the 5-year chart on Apple. Okay, you can drop it down to 1 year. You can drop it down to 15 minutes. You can drop it down to whatever time frame you want to work with. I generally start at the 5-year and then work my way down to the minute. So you can see based on this chart, it is in an upward trend. Okay, it is moving upward. So there's a pretty good chance that it will continue upward. How long it will take for it to go up, I don't know. You know, it does tend to have some volatility with the market, and it has reached all-time highs. It's at an all-time high right now, or it just passed an all-time high a couple of days ago. So let's just say, as an example, I thought this was going to go to 175, right? The next real point of resistance. If it breaks 150, 250, then maybe it'll hit 160. Well, let's just say that I think this is going to go to $160 because it's at 151. Its high was 151. If it breaks 150, 250, then 155, logically 160. So if I wanted to look at some options to be able to purchase, thinking that the stock price is going to go to 160 based on my technical analysis, based on my fundamental analysis of the company or news it's going to release or whatever it is that made me think that the stock's going to go up, right? Hopefully, you have an idea of why a stock would go up and not just guessing. This is Thinkorswim, but pretty much every platform that you're going to use out there has a similar setup. You can buy the options, you can buy the calls, you can buy the puts, and they're very organized, very detailed, easy to find. And they have a lot of information on there. For example, your probability that it will be in the money. So with the 155 strike price, okay, by the 17th of September, Thinkorswim says that there's a 22% chance that it will be in the money by September 21st. Now, the fact that it says it's a 22% chance that it will raise to 155 by, what, a month from now? I find that hard to believe. A lot of these, I know Robinhood has tools like this. Other places have tools like this, whereas the probability that it will be worth more or less. And they're not always accurate. So I never even look at them because it's just a computer that doesn't, if this algorithm was right on the percentages, then you wouldn't need to even watch this video. You could just say, oh, it's a 70% chance. Let me just buy that. And it would work, 70% of the time. You also have a lot of other tools in Thinkorswim and other platforms as well, but I'm using Thinkorswim. There's your theta. Your theta is your time decay, which, as you can see on here, is not very significant. It's 5 cents on this particular option. I could purchase this call when the market's open because it's closed right now for $1.26, $1.29 for 100 shares, for one contract for 100 shares. It would come out to $129 for that one contract for 100 shares of Apple. To be able to buy that for $155 anywhere from here to September 17th. If the price rose above 155 or even came close to it, even higher than it is right now, I'm going to make money on that call. Same goes for the puts. If you wanted to buy a put, say you thought the price of Apple was going to go down. You thought it was going to fall down to, I don't know, $130 and reach at this previous point of support here, around 127, 125, 30, in there somewhere. Then you could buy some puts. Say you could buy a put for $1 or for 135 strike price, which the strike price is just the price that the stock would be at, or that you're projecting the stock to be at. They expire September 17th. The puts, you could buy them for $84 for one contract. So you could buy 10 for $840. And for every penny that this goes up, that's $10 to you if you bought 10. And the price and the volatility, as you can see, in one day, this one specific put dropped 39 cents. So had you purchased these on Friday, which is yesterday, the day they were open, you would have lost $390. And some of this is also theta, time decay. It's not just about the price action. A good strategy for buying calls and puts is to go just inside the money or just outside of the money. That way there's a very high chance that it will at least oscillate around that price. So you have a good idea that you will have a chance to make profit, because it's going to oscillate around that price. As long as there's no major dip or major hike, some people do like the idea of buying very far outside the money and just hoping that the price skyrockets. But that's essentially gambling. If you just buy these dirt cheap ones for 2 cents, 3 cents, 5 cents, way down here, Like Apple's not going to fall to $82. But there's still some Yahoo out there who is buying a put for 5 cents. It's not a strategy that I would use personally. I generally like to be inside or close to the money. The furthest out I go from the money is 5 or 6. So basically you can straight buy calls, and that gives you the option to buy that stock at that set strike price that you chose because you think it's going to go above that price. Or you can buy put options, which gives you the option to sell that stock at a specific price because you think it's going to go below that specific price. So if you wanted to buy some Apple and you were thinking further out, you could absolutely, instead of buying 100 shares of Apple right now for $15,000. So instead of spending $14,800, you could just buy the calls for Apple stock and just stretch them out far enough in the time frame that you don't have to worry so much about losing money. So you can go to, say, January of 2023, right? Or maybe even further, maybe March of 2023. Because that gives it a whole year and a half to be able to go above 150, 155. You could buy them. You could buy the 100 contracts for $1,895 for the option to buy 100 contracts at $1.55. That is a whole lot cheaper than $14,800. And you don't have to worry about this expiring until a year and a half from now. So there's a good chance that this will oscillate and go up or go down. And at some point, if you're not good at trading and predicting the price and looking at all these different factors and can't keep up with it every single minute of the day, then the further out you buy, the higher the possibility of that stock actually meeting that price, as long as it's moving in the direction that you think it is going to go. So you can buy the calls further out, you can buy the puts further out. That gives you more time to be able to sell that call or sell that put so you can actually make money on it. What a lot of traders will do is they'll go further in on the time frames. They'll go to, say, the 5-minute, the 1-minute, the 15-minute, and they'll be day trading these. So essentially how that works is you have your stock, and on the open or the night before, they buy some contracts and just catch the trend. So whenever the stock hits a significant point of support or resistance, they will buy calls on support. If it breaks through that support level, they will buy the calls, ride the trend up, and sell those calls within a couple of minutes. Speed is the name of the game if you're going to day trade options. Same thing with puts. If a stock is going to fall, they will buy it when it hits either resistance or breaks through to the downside support, and then sell it very quickly within a couple of minutes or a minute, and basically scalp the options. If you're not familiar with scalping, there's a ton of videos out there, but scalping options, though it can be very risky, is a very good way to make a lot of money quickly if you don't have tons and tons of money. Now that you understand the basics of just buying a call, buying a put, pretty standard, pretty easy stuff, let's talk about writing calls and puts, covered calls and covered puts. Now, say you already have a little bit of money, kudos for you, and you own 100 shares or a couple hundred shares of XYZ stock. Let's say that you had 100 shares of Apple, 15 grand in Apple. You could buy covered calls. You're essentially writing a call and selling the contract to sell your shares to someone for a specific price. So your 100 shares that you own, you could say, I think the price is going to go down, so I'm going to write somebody a covered call for $155 because I don't think it's going to reach 155. You could also go further out and assume more risk. You could sell, I don't think it's going to reach 160 or 155 by 2022. If you sold 10 contracts, which would be 1,000 shares, that would be $7,300. Now, if you only had the one, it would be $730. If you own 100 shares right now, okay, if you owned 100 shares of Apple right now, and you wrote a covered call for your 100 shares to have to sell them to someone for 155, all that means is that worst case scenario, you would be forced to sell your stock to someone at $155, which is higher than the price that it's currently at. So you would still make money on that stock. You just wouldn't make as much as you would if you were right. So that's a very good way to be able to produce some capital. Basically a win-win. The only way you can lose in a situation like that is if the stock falls down below whatever premium you collected in your profits. So if the stock lost you more money than what you got in your profit. And it gives you more of a cushion to be able to let that stock fall further. Now, writing puts is basically giving someone else an insurance policy that you may have to pay out if the stock falls. So if the stock plummets, you may have to pay them an insurance policy payout. Essentially, that's why I don't like writing puts. I don't like the idea of writing puts. I mean, you could, if the stock is going to continue to go up, like let's use Apple as an example again. If Apple was going to continue to go through the roof, right, you could write some covered puts for 5 months out, 6 months out, a year out, however far out. So you could generate $1,950 for one single contract for 100 shares, March 17th, 2023. Now, if the stock falls down below 45 and stays below 145, then yeah, you're going to lose all of your money. No, not really, but you're going to lose more than you want to lose. So if you write a put option and it's far enough out, as long as the stock doesn't go down below that price, then you're fine. You're good. You just got free premium, essentially. And if the stock's going up, guess what? You still made money on the stock too. So you made money on the premium and you made money on the stock. But if it goes against you, then you're going to wind up losing some money. Theoretically, it should all work the same way as writing calls, writing puts. They should work in similar fashions. But for whatever reason, I just like the idea of writing calls on something more than I like the idea of writing puts. I don't know why. That's just me personally. So there you go. There's your basic overview and two main ways that you can make a bunch of money on options. You can trade daily. You can swing trade. You can trade long term. You can hold for 50 seconds or a minute or 10 days or 10 weeks. You can hold for any period of time. So if you have an idea of the price and the idea of how long it'll take, then you should have no problem buying calls and options. Did I explain the options so you can understand it, or does it make sense, or am I just basically a blithering, blabbering moron and you can't understand anything I'm talking about? Probably, I don't know. Hopefully some of that helped you, and most of the information that I look at when I'm looking at charts has to do with technical analysis, because that's sort of my bread and butter. I do some fundamental, but most of it's technical analysis. So if you guys want me to share how I predict stock prices or how I see things going, let me know. I'm definitely not an expert, but I have been trading for a long time, and I've read a lot of stuff. And hopefully me sharing this stuff with you will help you get some of these. I hope you guys enjoyed the video. Smash that like button. I hope it wasn't too mind-numbing and boring. It was kind of mind-numbing and boring talking about it, if I'm being 100% honest. But yeah, hopefully it helps some of you guys out. Catch you guys in the next video.
I don't take no L's, only dubs on my mind, yeah.